Jim Allen, President and Chief Financial Planner here at Anchor Bay. Along with me tonight is Blake Pinion, one of our financial planners and tax specialists. And so we're going to talk tonight about kind of a dirty word in the financial industry, reverse mortgages. And we're going to go through the good, the bad, the ugly, pretty much everything you want to know about reverse mortgages. So some housekeeping things before we get into the agenda here. We're happy to answer any questions you have. What you could do is you could just type them into the chat or the Q&A, and we'll address them at the end of the presentation. Also, this presentation is being recorded, so probably sometime early next week it will be posted on our website if you want to go back and re-review it, or if you want to share it with friends or family, etc. So let's go ahead and just jump right in. Here we go. So what are we going to talk about? So, I mean, the topic is reverse mortgages, how they work, are they good, are they bad, etc. But we're going to start with just talking about, where you're going to live in retirement as a starting point. So, do you plan on aging in place, which means just staying in your home? If you're going to do that, can you do that? What are the pros and cons? Should you pay off your mortgage? All of that kind of things. What are the other options, like, selling your home and downsizing, moving into assisted living, whatever. And then we'll talk about how reverse mortgages fit into the whole housing during retirement scheme of things. And then we'll go pretty deeply into how they work, the tax treatment. There's a bunch of different ways we can use them, so we'll briefly touch on all of those and kind of give you a couple of case studies. We'll talk about the pros and cons, and then we'll kind of give you our take on these things. But I just want to start with stating up front is we do not have any type of affiliation or skin in the game when it comes to reverse mortgages. We don't make money off of them. We don't sell them. We don't get kickbacks from reverse mortgage brokers. So we can give you our unbiased opinion on these things because we don't have an ulterior motive. When we're working with you as clients, we're working with you as a fiduciary. So everything we're recommending to you, the advice we're giving, is what we feel is in your best interest. And so, we just want to make sure up front that, there's no ulterior motive here. We're going to give you our unbiased opinion of these things and answer your questions honestly. Because reverse mortgage is one of those topics where very frequently when we bring it up with a client, we're in a seminar or something, we kind of get the Dracula thing. It's like, back up, because they do have a negative stereotype, and some of it's well-deserved. And so whether it's reverse mortgages or annuities or life insurance, topics that are, products that do get abused by people in the financial industry, just know that we don't market or sell any of those things. We don't make a commission on any of these things. So we're giving you unbiased advice. So let's just kind of jump into it here. So let's talk about living arrangements in retirement. Obviously, you have to live somewhere when you're retired. And you've got a bunch of different options. You can stay in your current home, which for a lot of people is the goal. And if it's not your current home, it's probably your forever home, which means you may sell and trade down or downsize to something that's smaller. Maybe it's more feasible, maybe it's less expensive, and that becomes your forever home. So the first decision is, am I going to stay where I'm at now, or am I going to sell and trade down? That's choice number one. Another choice that never gets talked about, very rarely does it get talked about, but sometimes it makes the most sense, is like, you don't need to go buy another house. Depending on your time horizon, how long, you think your life expectancy is going to be, your financial situation, your, the ability to like freely move around. Maybe you're better off selling or renting and using those proceeds to live off of and pay rent. It's an option that doesn't get considered a lot because it's kind of been, beat into our heads by our parents that, you need to have a paid for home when you retire. Well, times have changed. And so maybe selling and renting is an option for you. Or maybe it's selling and renting for a period of time till you figure out where the heck you want to be. Sometimes it's, you're going to have to move into a retirement care community. assisted living, a nursing home. That may be something that you have to do. And then the other option is, you could go live with your family, or your family can come, live with you and provide support. A lot of times now we're seeing this trend towards, I guess, they're called granny flats, where, if you've got a large enough property, you build another smaller home in, somewhere on the property for, mom and dad to live in during retirement. So this is probably one of the major decisions you're going to make during retirement. And it's not just a financial decision, it's also a personal one. And it can be really hard, if you've lived in a house 30 or 40 years, you've raised your kids there, everything else, to all of a sudden move out of that. It can be a daunting task. So this is a big decision. It comes with emotional and financial baggage, but it's something that everyone's going to have to deal with at some point in the future in retirement. Okay, so the things you need to consider about where you're going to live in retirement is maintaining your quality of life. For example, you're in your 80s, you're in your 90s, or maybe younger but in poor health. How are you going to get around? How are you going to get around your home? How are you going to get around town? Safety concerns, not only issues with like slipping and falling, things like that, but how safe is the neighborhood anymore? It may have been great when you moved in 30 years ago, but not so great anymore. Is the house safe? So you've got to, do you have to put in grab bars and a stair lift and all those kind of things? It's like getting help. You probably may not be able to clean the house anymore, or do the yard work. So do you have people who can help you with those things? Then obviously the financial costs, the upkeep of the house, the property tax, the insurance, all of those things kind of, factor into, where are you going to live if you're going to age in place, and how feasible is it? So, that's issue number one. It's like, okay, do you want to live in this home? And if you don't, where are we going to go? And then the next thing is, you're now in your forever home, wherever that's going to be. Are you going to have a mortgage? And as I mentioned before, before it was, my folks brought me up this way. It's like, you can't retire till your house is paid off. You need to get rid of that mortgage payment. The baby boomer generation, I don't think sees it that way. There are more and more people that go into retirement with a mortgage and they're fine with it. And so, one of the things you have to look at, whether it's a regular mortgage or a reverse mortgage, as we're going to talk about, is like, how does it feel to have a mortgage in retirement? Are you okay with it, or does it really bother you? Kind of the way to look at this is, which is more important to you? Is it having that paid for home, or is it having money in the bank? Because if you pay off your home, and we'll talk about this a little bit more, now you could end up being house rich and cash poor. So it's like, yeah, you've got a paid for home, so you don't have a house payment, you've got all this home equity, but you have no way to access it, and you don't have any cash. Other people's like, I don't care, I can have the mortgage because I've got money in the bank, or I can make the house payments. So neither approach is right or wrong. It's whatever you're most comfortable with. And when we're dealing with a married couple, there's a lot of times where, they both feel about one or the other, and it could be a source of conflict. So let's say you want to pay off the mortgage. So how do we do that? Ideally, we've planned, and it was a goal, and we've worked towards that goal. So we've made extra payments, things like that. But let's just say you're heading into retirement, you've got a small mortgage left. So how do we pay that off? The ideal situation is we just have some money in an investment account, some cash, whether it's a CD or a savings account, or a brokerage account with some treasuries, and we can just withdraw that cash and pay off the mortgage, and you're done. So as I mentioned, so now you don't have the mortgage, but you also don't have the liquidity. The next option would be, ideally, if we don't have just cash in a brokerage account or savings account, we could tap into your Roth IRA. Why would we want to do a Roth IRA instead of a regular IRA? Because the Roth would be tax-free. And I'll show you an example in a second here about why it's not a good idea to do this with the retirement plan. So if we don't have money in an investment account, we don't have money in a Roth IRA, the next option is, okay, we can tap into our 401k or our IRA, and we can pay off that mortgage. Is that a good idea or not? And so we'll talk about that a little bit more. The other option that we're going to talk about when we get into the reverse mortgages is you can use a reverse mortgage to pay off a traditional mortgage. And so you still have a mortgage, but you don't have a house payment. And so one of the goals is to not have the house payment. We can accomplish that. So the big question about the mortgage and retirement is, A, which makes you feel most comfortable, not having the mortgage or having money in the bank? And then, looking at it from a financial standpoint, is there a financial benefit to paying off the mortgage? So let me show you an example how this would work. So let's say you've got a $100,000 mortgage and you've got a 4% mortgage rate. So your interest cost each year is $4,000. So if we paid that off, now you're not paying $4,000 of interest. So it's like you earned $4,000 on that $100,000. That's a 4% rate of return. And the way to look at that is that's a guaranteed rate of return. You didn't have to pay the $4,000, so it's guaranteed. There's no risk involved. So if I can get a 4% rate of return guaranteed in today's interest rate environment, that looks pretty attractive, because you can get 1.5%, maybe 2% now in treasuries, things like that. So that looks pretty good. But let's say that you're deducting your mortgage interest. A lot of people with mortgages that size anymore, because of the way the standard deduction works, you don't get a deductive. Let's just say you're deducting the mortgage interest. So now really that cost isn't $4,000 because you're deducting it. Let's say it's a 33% combined tax bracket between 24 state or federal and 9% state. So now really that interest cost is only $2,680. So paying off that 4% mortgage, you're either going to get a 4% rate of return if you're not deducting the mortgage interest, or a 2.7% rate of return if you are deducting the mortgage interest. Both of those are pretty good in today's environment. A year from now, they may not be, but in today's environment, they would be. So, that's not a bad choice. If you've got $100,000 of idle cash, that's earning nothing at the bank, this may make sense. It makes sense financially. And then the issue is, are you going to leave yourself with enough liquidity if you take that money out of the bank? But let's just say you've got to use your IRA to pay off this mortgage. It's the only tool you have. So now the IRA withdrawal is going to be taxable, meaning that you've got to pay off the $100,000 for the mortgage. You also have to pay the tax. And so you end up with a circular transaction. So if you want to net $100,000 at that 33% tax bracket, you've got to actually pull almost $150,000 out, $149,253. So this would be a 24% federal bracket, a 9% state bracket. And so now, is this a great deal? Now, to save essentially $4,000 of interest, I had to spend $150,000. That lowers that rate of return to 1.78, just about 1.8. So that doesn't look so good. So, if we have liquid cash and we still have plenty of liquidity, or if we have a Roth IRA, then this might make sense to do it. But if we've got to pull the money out of the IRA, it probably doesn't make sense to do it. You've got to want to have a paid off house, really bad for it to make sense to essentially require another $50,000 of withdrawal to pay off that $100,000 mortgage. So the next option, if you're not going to age in place, is to trade down or downsize. So it could be you can't or don't want to age in place. Maybe the house is too big. You really can't fix it up to stay there, or maybe you don't have that support around you. So lots of reasons why you may want to trade down. So you're going to sell your home and you're going to move. Maybe it's for warmer weather. Though for our Southern California clients, maybe you go from the Inland Empire to San Diego or something for nicer weather, but you can't get too much nicer than we have out here. But clients that are in colder climates, they may move to warmer weather. A lot of times it's people in the Northeast moving down to Florida, or people in the Midwest moving down to Texas, things like that. Maybe you want to move closer to family. Maybe your kids have moved across the country. My daughter moved to Washington, D.C. several years ago, and that's her home, and she's not coming back. So a lot of times people will move to be closer to family, grandkids, whatever. a caveat on that is that if you do that and then the kids decide they want to move to somewhere else, you can end up trying to, chase them around the country. So, again, personal situations come into play as to whether that makes sense or not. A lot of people will do it for tax or political reasons. California is a heavily taxed state. So we've got clients who have moved to Texas, or they've moved to Nevada or Washington State in order to avoid, these high taxes. You could have people that are going to snowbird. They've got a home here, for the winter, and then they've got a home somewhere else for the summer. Those kind of things. And a lot of times the reality is we're just doing it because it's lower cost. You have to do it financially. If you want to retire at X age, your options are to save a bunch more money, or spend less, or work longer, or you sell the house and you trade down. Very difficult to trade down in Southern California. Housing prices are just so high that, it could still make sense. But a lot of times when you're trading down, you're moving out of state. Okay, so now we decided we're going to downsize. So the question first is, okay, now do we pay cash for the new home? It gets back to that mortgage payoff question. Like, okay, I'm going to sell this house and I'm going to buy a new house and I want to pay cash and I don't want to have a mortgage. So that's the answer number one. Answer number two is, okay, I'm going to carry the mortgage because maybe I don't have enough cash to pay cash. But, if we're in retirement, trying to qualify for a mortgage and you're not working, while not impossible, is very difficult. You could have a ton of assets. You could pay cash for the house, but the banks want to see, for whatever silly reason, is like, okay, where's the income coming from? And it's like, well, I could just withdraw this money from my Schwab account and write a check, but they don't care about that. They want to see that you're taking out $5,000 a month for the mortgage payment or whatever. And here, a reverse mortgage can be used, and we're going to talk about a trade down using a reverse mortgage. And then as I talked about before, it's like, a lot of people in today's environment, with the prices you're getting for your homes, maybe it makes sense to sell your home and then you just rent for a period of time, or you live in the RV and travel around, and you buy a house when the market corrects, or when you figure out where you want to eventually live. Okay, so if we're going to sell, there are tax consequences. And so we'll briefly talk about that. So, if we're looking at you're selling your home, it is a capital gains transaction. And so it's your selling price over your cost basis is the amount of capital gains. And so what cost basis means, it's what you paid for your home originally, plus all of the stuff you've done to improve the home over the years. You've added a patio, you've changed the kitchen cabinets, you put in tile floors, all of that kind of stuff. Those are improvements. And again, most people don't keep track of that stuff, but we recommend that you do. So when you go to sell the home, if the IRS questions it, we can say, no, look, over the last 25 years, we put an extra $50,000 or $100,000 into this house, and we have the proof. Okay, so that's your cost basis. Your selling price is whatever it's listed for, less all your selling costs. You're going to have to pay a realtor. You got to pay the escrow company. You subtract those costs. And the difference between those two is your capital gains. And now you have a $250,000 per person exclusion available. So that's per person. If you're a married couple, you have $500,000. The rule with that, and there used to be rules where you could only do it once over 55, things like that. The rule now is you can do this, essentially every couple of years. You have to have lived in the home and owned the home for 2 out of 5 years in order to get the exclusion. So you buy a new home, you live in it for 2 years, you could sell it and get another $250,000 exclusion. So you have multiple exclusions over your lifetime anymore. And if you're a married couple, like I said, it's $500,000. So here's an example. So your home sells for $750,000. You bought it originally, in 1985 or whatever, for $375,000. So you have $375,000 a gain. You subtract, say this is a single person, a $250,000 gain exclusion. So now you've got $125,000 taxable gain. And so if you're in the 15% capital gains bracket. And the capital gains brackets range from 0 up to 23.8. But let's assume that you're in the 15% bracket, which many people would be. That's $18,750 of federal tax. Let's say this is a California home. Unfortunately, California doesn't have a capital gains tax, so it's going to be based on your tax bracket, which for most individuals is roughly 9.3%. So you're going to another $11,600 for California. So your total tax on that $750,000 home is $30,000, $30,375. And as I mentioned, capital gains at the federal level, depending on your income, it could be 0. It could be, for most people, it's 15. The next tier is you have what's called the NII or Obamacare tax, which adds another 3.8% when you're above $250,000 for a married couple. And then finally, you get to a 20% bracket plus the 3.8, so you get 23.8%. Ideally, the exclusion covers all of the tax. The way the housing market has gone over the past couple of years, we're seeing more and more people who aren't under the exclusion anymore, and you're going to end up owning a little bit of capital gains when you sell your home. Okay, so the next question is, let's say you want to age in place. It's can you? Again, kind of the questions we had before. What are you going to do for transportation? If you're still driving, great, but at some point you probably aren't going to be able to drive. Do you have healthcare around you? Are you close to the hospital? Are you close to your doctors? And can you live in the home? The home I have currently, it's over 3,000 square feet. It's got big yards. All the bedrooms are upstairs. Like, it's not going to be that feasible when I'm 85 years old to do that. So, you can do things like you could put in one of those stair chairs, and you could put in handrails in the bathrooms, or you could put, a downstairs bedroom, or you could add ramps. So you can do things to make the house livable. And, people will do that where essentially the upstairs doesn't get used anymore. The question is that cost effective? Can you afford to do this? And then you got to look at the cost of living where you're at. And so when we're doing the financial plan and we're looking at your income plan, we got to look at things like, what's your mortgage payment going to be? What's your property tax in your homeowners association? How much are you going to have to spend for upkeep and repairs? Are you going to need to drop $30,000 on a roof in the next couple of years? Are you going to have slab leaks that have to be repaired? So you got to look at all those kind of things and determine whether, you want to live there. Is it feasible to live there? And then can you afford to live there? And what some people are doing now, it's kind of a trend, is, they want to stay in their home. They have 4 or 5 bedrooms, and, they're empty nesters, or maybe it's a widow or widower, they're just by themselves. They'll rent out rooms as an additional income source. And, they'll become a landlord and use up part of their home that way. So you have a lot of different things you can do. And it's going to boil down to your individual situation as whether this is feasible or not. Okay, so let's say that you are going to age in place, or you've downsized and you've moved to your forever home, and you've got home equity. And in a lot of cases, home equity is either your largest or your second largest asset behind maybe a 401k or some other retirement plan. So, how can you tap into that home equity while you're alive? And so that's what a reverse mortgage does. It's a way to access your home equity while still living in the home. Now, you can do that with a regular old home equity line of credit too, a HELOC. The problem with a HELOC is, A, you have to qualify. And if you're retired and you don't have, employment income coming in anymore, you may not qualify. And B, with a HELOC, you have to pay it off. It's usually interest only for a period of time, and then it amortizes, and you got to pay the interest and the principal. So, home equity line of credit is an option, but you do have to make payments on that. With a reverse mortgage, it's a mortgage, but you don't have to make payments. Essentially, the interest accrues, and then the home is paid off when you leave, either because you passed away or you've moved out of the home. And we'll show you how that works with mechanics in a little bit. So the difference between a reverse mortgage and a forward mortgage is you don't have to make the payments. So you're not paying it off down to zero. If anything, the loan is growing because you're not making the payments. You're still being charged interest. The interest is just accruing, and the balance grows. The other kind of unique feature about a reverse mortgage is that you can never owe more than the value of the home. You're going to pay a kind of an insurance premium to FHA for what's called a non-recourse feature, meaning that you can never owe more than the house is worth. And I'll show you an example how that would work in just a few slides. So are they a good or bad deal? I mean, you see the commercials all the time on TV. You know, if I'm watching reruns of NYPD Blue or something, you know, you see Tom Selleck, you see, Henry Winkler, you see Steve Garvey, and they're all pitching, you know, these things are the greatest things ever, you know, and, you know, can you believe that? On the other hand, you'll hear a lot of, messaging about, oh, they can take your home away, they're very expensive. So what's the truth? And, you know, the truth is somewhere in between. So the way we look at it is, you know, it's just a tool in the toolbox. And so, you know, we have lots of tools in our toolbox when it comes to retirement. It's Roth IRAs, it's your 401ks, your IRAs, it's Social Security, it's pensions, it's annuities. Tapping into home equity is another one of those tools. And so whether it makes sense for you or not, you know, there's a bunch of variables. A is like, how much home equity do you have? If you don't have a lot, it's not going to do much. But if you've got, you know, several $100,000 of home equity in there and it's your biggest asset, maybe we should look at tapping into that. What other sources of liquidity do you have? You know, if that is most of your nest egg, then, you know, we probably have to tap into it. If you've got a bunch of money sitting in brokerage accounts or Roth IRAs or something, then maybe we don't have to tap into that home equity. Legacy goals. This is one where there's, I think, a lot of confusion. Is that, you know, oh, you know, I want to leave the home to my kids. You know, we serve as trustees and administrators on estates all the time. What we see is the house gets sold. So if it truly is like, you know, I want to make sure my kids want to take this house and they're going to stay in it, great. But if they're just going to sell it, you know, you can leave them other assets. You know, if we spend the home equity, but we maintain the stock portfolio, they're going to end up with the same amount of money. It's just coming from a different pocket. So I think, frankly, that whole thing about, oh, you know, I want to leave the home to the kids is overblown, because rarely do we see where the home actually gets kept. Interest rates, you know, play into this. It's like, okay, it is a mortgage. You're going to have to pay interest. What's the interest rate? They've been extremely low for the past, you know, several years. Now they're going to start creeping up. And so is a reverse mortgage going to be cost effective? And then the biggie is the plans to stay in your home. A reverse mortgage is not feasible unless you continue to stay in the home. So, you know, that's kind of the biggies. Hey, I'm going to sell this house in a couple years, reverse mortgage doesn't make sense for you. So let's talk about the mechanics. So it is a mortgage, just like a regular or forward mortgage is. And so you're going to borrow against your home equity. The differences are, one borrower has to be at least age 62. This is a rule change. Before, it's like everybody had to be over 62. And now you can have a person under 62 also be in the home. But one of you has to be at least 62. You can't have a regular mortgage. So it's not like this is a second mortgage or anything like that. It's like, you know, this is your only mortgage. And the max loan available is based on your age and home value. We'll show you kind of an example how that works. And qualifications based on your home value. So this is one of the beauties of this is you're in retirement, you don't have a paycheck coming anymore. So if you tried to go out and get a regular old mortgage or even a home equity line of credit, you may get declined because you don't have a regular income stream. Now, if you've got pensions and Social Security, yeah, maybe you could still go out and get a forward mortgage. But a lot of times it's really tough to qualify for a regular mortgage when you're in retirement. It's like, do you have enough home equity? And the only income requirement is you've got to maintain the home. So you have to pay the property tax, you have to pay all of the maintenance, you have to pay the insurance. And so the lender is going to make sure that you've got enough income to pay all those upkeep costs. Because, when you hear stories about, oh, they took this person's home, the reason they took the person's home usually is because they're not maintaining it. They're not paying for the upkeep. And so they foreclose on the home. But there's a lot of protections built in nowadays that didn't used to be there. And so unlike a regular mortgage where you're paying interest and principal, in this case, you don't pay anything, the loan interest just accrues. And so the loan's going to grow. Now you can make payments. So in theory, you could make principal payments, you could make interest payments, you can make no payments. You can make payments sometimes, you can make payments none of the time. So you've got a lot of flexibility. So it's not like you don't have to make a payment. You can if you want. So here's the catch. These things can be really attractive, but as I mentioned, since interest accrues, this is like one of the misconceptions. The lender is not going to loan you all of the money. So let's say the house is worth $750,000. They're not going to loan you $750,000 because the next day when the interest accrues, they're underwater. So they do a calculation based on your age and based on the home value and some other things as to how much they will loan you. And so that's one of the important considerations is, okay, how much will they give you? Now, the older you are, the more they'll loan you because the loan isn't going to grow as large because you're not going to live as long. So the younger you are, the less they're going to give you. The higher the interest rate, the less they're going to give you. Because they're calculating what that loan is going to grow to over a period of time. And then they kind of come up with, okay, this is the maximum value we'll loan you so that we don't end up underwater at some point in the future. So here's a real life example of a client we worked with recently. And this was kind of a unique home. This is a very expensive home. This was in Los Angeles. This is a 70-year-old. The home was worth $3 million. So this is not your typical reverse mortgage, but she had, $2.5 million of home equity. So the max loan that they would give her based on her age and the home value was $1,602,000. So, roughly, a little more than half of the loan value at age 70. And what she was going to do is we were going to pay off her regular mortgage of $600,000. The rest we were going to use to live off of, in a line of credit. And that was based at a 5.8 fixed interest rate. So what would change that $1.6 million would be if she was younger or older, and if the interest rate was higher or lower. But that kind of gives you an idea of, you're not going to get a $750,000 loan on a $750,000 house. There's going to be what are called holdbacks so that the loan doesn't grow too large too quickly, because as I mentioned, you can never owe more than the home is worth. So here's the mechanics. You pay this FHA fee to make that loan non-recourse, meaning that in that $1.6 million loan in the previous example, if that loan grows to $4 million and the house is only worth $3 million, when the house is sold, the $3 million goes to the lender. The other $1 million that they're underwater comes from FHA, business insurance premium. So that's one of the costs you pay for. And that's an important cost because you can't be underwater. Or in a regular mortgage, you can. I mean, there are plenty of people in 2007 to 2009 that ended up having a short sale and they got less than the mortgage is worth, et cetera. So that non-recourse feature is an important provision of a reverse mortgage. You have a maximum lending limit, which is set by the FHA. So essentially, they're only going to look like $1 million of value for your home. And the one I just showed you was $3 million because that was a jumbo loan. So they now have these jumbo loans where you can have very large home values and do a reverse mortgage. So here's the other kicker. The loan becomes due when the homeowner leaves the house. So whether that's because the homeowner's passed away, the homeowner's unable to live there, they've had to go into a nursing home, or they just decide, you know what, we're going to sell and we're going to trade down. That's when the loan becomes due. And so the house can be sold, the loan can be paid off. Best case scenario, there's remaining equity that the homeowner would get. Worst case scenario is they walk away with nothing. They don't owe more than the house, but they also could get a zero. And there's a variety of loan options that we'll talk about. So you can pick a bunch of different terms in terms of how you want to use a reverse mortgage. So let's talk about some of the costs. So you have the normal mortgage origination fees, just like you do every other mortgage. So you got to pay the escrow company, you got to pay for appraiser, you points, all that kind of stuff. All of those costs are very similar to a regular mortgage because it is a mortgage. You can get a reverse mortgage that's a fixed rate or an adjustable rate. And the amount of the holdback and the options and everything will vary based on the fixed or adjustable rates. You're going to pay a fee for that FHA non-recourse mortgage insurance feature. So what happens is when you first start the reverse mortgage, you pay a 2% of the loan amount as a one-time fee. So if it's $1 million home, you're going to pay $20,000, as the FHA fee to start with. Then every year you pay 0.5%. But that protects you from, ever owing more than the home is worth. And the way these things work is when you look at a proposal by a loan mortgage broker, because you have costs, the longer you hold this, the lower those costs get. So if you're going to do one of these and then 5 years from now, you're going to sell the home, you're not going to be there long enough to recover all of those costs. But if you're going to do this and be in the home for 20 years, those costs overall become very low, and they're really not a big deal. But what you want to know is the cost will be higher than a forward mortgage simply because you're going to pay that one-time 2% fee, and then you're going to pay that extra 0.5% on annually for the FHA. So you are going to pay more. Are they expensive? That's a relative term. I mean, when you factor in tax savings and liquidity and all that stuff, it's like maybe it's not expensive. It's something we have to analyze and figure out whether in your situation it's an expensive option or not an expensive option.
And Jim, can I add real quick to that?
Sure.
So a lot of people think about a reverse mortgage as a last resort, and I don't think that's a great way to think about it. I think he just pointed out there that the earlier you take a reverse mortgage on, the more that you have the time to recover the costs. So it may not make sense to think about taking it on as a last resort when you're 70 or 80 or 85 years old. It's actually more compelling maybe to take it when you're in your 60s because you have that long runway to recover the costs. And then what he's going to talk about shortly here, you also have the ability to increase line of credits.
Yeah, Blake's absolutely correct. And Blake, you were going to cover this topic too. So I'll just let you keep going.
Okay, perfect. Yeah, so reverse mortgage tax treatment. So a reverse mortgage, the proceeds are tax-free. So that's kind of a compelling reason there. Just like a HELOC or a home equity, you don't have to pay tax on the money that you get from the reverse mortgage. And it makes sense if you think about it. It's not a taxable distribution, it's a loan. So therefore, the IRS doesn't consider it a taxable event. And then unless loan interest is paid, there's no mortgage interest deduction. So that's the thing to consider. You're not going to be getting any interest deduction, but as Jim mentioned, you're not going to be having to make any payments. The interest will accrue. So the higher your potential tax bracket, the more cost-effective a reverse mortgage comes. So as Jim talked about with the IRA example, it could make a lot of sense if, say, a lot of your nest egg was tied up in a retirement plan like an IRA. Instead of taking money out of that, maybe you supplement your income from a reverse mortgage so you don't have to pay those taxes. So it could be very compelling to someone who has a lot of money in those tax unfriendly type accounts like IRAs.
Yeah, so kind of an example there, Blake, would be, let's say that you've got to, put $50,000 for a new roof. If I do a reverse mortgage, say from a line of credit, I only have to take $50,000. If I've got to pull that from my IRA, I've got to pull 75 to 80,000, depending on your tax bracket. So, you know, we just saved $30,000 in tax by using the reverse mortgage. You know, that helps offset those costs that you're paying.
Yeah, and it's dynamic too. I mean, tax rates right now are the lowest they've been in a long time. We've done a presentation on how high tax rates have been in the past, but when they go up in the future, that's just going to make a reverse mortgage seem a lot more attractive. So that's the advantage. You can always adjust and utilize a reverse mortgage based on the environment.
Okay, so let's give you an example here of how these things would work. So let's just say the home's worth $400,000. And, you know, based on the age and everything, the starting loan amount is $165,600. And there's lots of different ways to take that $165,000 that we're going to talk about in just a couple slides. So let's say 10 years from now, the home has grown at a 4% rate. So now the home has gone from $400,000 to $592,000. The loan has also accrued interest at 6%. So it's grown from $165,000 to $296,000. So let's say 10 years from now, the client's passed away, or they've had to go into a nursing home or something like that. So now we sell the house. So the $300,000 loan, the reverse mortgage becomes due. When the house is sold, the loan gets repaid. And in this case, the homeowner would still have almost $300,000 of equity available. And this is frequently the case. It's like the home is going to, you know, because of the way they you know, design the holdback, the home is going to continue to be, you know, well above the value of that loan. Now, you could have another 08 or 09 where at the time, you know, the market's down, but in general, you're always going to have some equity left over. So the owner in this case could sell it. They could pocket the $300,000, use that for nursing home expenses, whatever. Now let's just say that the home is only worth $285,000 at that case. So the market's really tanked. In that case, the loan is $296, the home's worth $285. The home gets sold, the mortgage gets paid off at $285. FHA gives the lender the other $11,000, and in this example, then the homeowner would walk away with nothing. So that is a risk, but you know they're designed properly, and there's a lot of protections where it becomes a much smaller risk, you know, based on the protections and the way they do the holdbacks and things. Then these things were done, you know, 10, 15 years ago. So what are the options for using a reverse mortgage? The one that everybody thinks of, and the one that was, you know, originally touted when they first came out, and the one you always hear from Tom Selleck, et cetera, are, you know, income payments. Like, okay, I have that, I've got $165,000 they will loan me in a reverse mortgage. I can take that $165,000 in monthly payments over my lifetime. So, you know, maybe that's $1,300 a month or $1,500 a month or something like that for life. What's called a 10-year payment. I could say, okay, I don't want it for life. I just need it for the next 10 years. And so then maybe that payment now goes from $1,300 to $1,900 or something like that. So you can take income payments, and you know that's an option. Another one is the one that I'm most in favor of, is doing a line of credit. So it would work just like a HELOC. We need $50,000 to put a roof on the house. We tap into it for $50,000, and it's tax-free. And now I've got a $50,000 mortgage, which will grow. So there's lots of different ways to use a reverse mortgage line of credit. We'll talk about all of these in a little more detail in a minute. Another one that I think is really a good one that people don't know of is, okay, you can pay off your existing mortgage with a reverse mortgage. So you still have a mortgage, and if anything, the mortgage is going to grow, but you don't have a payment. And so, you know, if I've got an $1,800 a month house payment, and you know I want to retire and I really can't afford that extra $1,800 a month, we do a reverse mortgage, and now you can retire, and you don't have to worry about making that house payment. Are you going to use up some of your home equity and maybe leave a smaller legacy? You are. But you're accomplishing your goals. And so, it's a great way to do one of these. You can use it to actually trade down, and we'll talk about that. Or you can use a bunch of combinations. One that we do a fair amount of when we use these in the example we had with the $3 million home, we were going to pay off a $600,000 existing mortgage, and then we were going to have $1 million line of credit that we were going to use for travel and things like that. So you can use them in a bunch of different ways. It's not just, hey, they're going to send you a check, because you're 85 years old and you're running out of money. That's the way they were originally kind of designed and marketed. We rarely, if ever, use it that way. It's these other strategies that we think are more compelling.
Yeah, and I think the line of credit is really important to notate. If you were to have an unexpected health event, you need $20, $30, $40,000, you could use a reverse mortgage, tap into that line of credit. So it gives you the peace of mind you have that level of an emergency fund in the form of line of credit.
Yep, absolutely. And another reason to set them up early and get it done and in place. So when that emergency happens, you're already set up. So in terms of the income payment, as I mentioned, you can take it over a term of years, you could take it over life. And the thing, if you're taking it, say, for life, if the house becomes underwater, meaning the loans exceeded the home value, you still get those payments. So in that manner, it works very much like an annuity. And so you can continue to get the payments. How much they'll give you depends on your age, the home value, and the interest rate. So it all boils back to that calculation about how much they're willing to loan you in terms of how much you'll get in an income payment. The line of credit, is, Blake and I have both said, is the one that we prefer if we're going to use these. So it works very much like a normal HELOC, except you don't have the payments. And the interest is only charged on what you use. And so, ways we could use that, that home repair. A biggie, I think, is, let's say you're going to need home health care. And so, what the common option is, okay, we could go out and buy long-term care insurance, or, some of the other hybrid policies and things like that. They're extremely expensive anymore. They're limited availability. And so they're not as attractive as they were when they first came out, 20, 25, 30 years ago. So if we need home health care, and this is one of our largest assets, we can tap into this tax-free and use it to pay for home health care. Now, we can also use it for a nursing home, but remember what I said earlier is that the loan becomes due when you move out of the home. So if you've got a single person and they have to go to a nursing home, the loan's going to become due. But if you've got a married couple and one of you has to go into a nursing home, we could use the reverse mortgage to pay for that nursing home care. So I like this as a potential, long-term care solution. Is it going to be perfect? No, because I mentioned, if you're a single person and you have to go to a nursing home, it's not going to, necessarily work. But if the home gets sold and there's still remaining equity, that could be used for the nursing home. The strategy that we really like is to use this as portfolio protection. And so this is the way this works. And there were several studies done by some academics, I think starting back in 2012, where they looked at this concept. So you have a reverse mortgage line of credit. What's the market done the past couple months? I mean, it's down 1,000 points again today. So we have volatility. So let's say that you needed money, right now to live off of, but you don't want to sell your stocks when they're down 6, 8, 10%, or your crypto when it's down 50%. So then what we'll do is let's tap into the reverse mortgage line of credit. So if we're living off 50,000 a year, we'll take 50,000 out of the reverse mortgage line of credit, tax-free. We can live off of that, and we leave our investments alone and let them recover. And then when the market does recover, we've got a couple options. One is we don't do anything. We just keep the reverse mortgage loan in place and let the interest accrue. Or we could, now that we have the market's recovered, we could sell some of those investments and repay the loan or pay it off or make interest payments. And so, and again, the loan proceeds are tax-free. So rather than, you know, adding insult to injury where I've got to, you know, take 50,000 from my IRA and pay the tax and we're down 10%, this is a way to not have to do that. Now, if we're managing your money, ideally, we're not going to have you in a situation where you're going to sell stocks in a down market anyway, because we're going to make sure you have enough liquidity so that we don't have to do that. But this can be a really attractive alternative. And like I said, these academic studies have shown that this can improve your probability of success by, you know, 10% or more. So this is another option. You know, is it right? It all depends on, you know, how your investments are, the liquidity, all those kind of things. But that home reverse mortgage line of credit can be really attractive for nursing home, for those emergencies, and for portfolio protection. Okay, so here's the HELOC example again. So we have $400,000 home value. They're going to loan you the 165.6. So you have that available to tap into. But the beauty of the HELOC example too is because of the way they hold it back, as you get older, the amount that they'll loan you gets larger. And so that line of credit grows for every year, you know, that you're in the mortgage. And so they changed it. It used to be where it would be growing at 6 or 7%. I mean, it was an amazing concept. They've changed the way they calculate that stuff, but it still can be really attractive because that loan will continue to grow. So we've got it in place, and if we're not using it, it just continue to grow and get bigger and bigger and create a bit larger pool of money for you to tap into. And unlike a regular HELOC, you don't need to qualify based on income. This is based solely on whatever they'll loan you based on your home equity. So I think you can tell Blake and I are both pretty big fans of this concept. Again, you got to look at the costs. You know, this could be a great idea, but if you're going to sell the home in a few years, you're not going to, you know, recoup your costs. But if we're going to have this over a 10, 15, 20-year period, this can be a really attractive option for you. One last one is what we call the reverse mortgage exchange. Okay. Actually, I've got two more. Sorry. So here, what we're going to do is we're going to use that reverse mortgage to eliminate a current mortgage. And that's what we did in that $3 million example. Is we took a reverse mortgage, and she had a $600,000 outstanding mortgage. We paid off that mortgage, which freed up, you know, a $3,500 plus house payment, which, you know, gave her the ability to retire. So, you know, when you have, you know, that kind of that home equity, you know, the loan's going to grow, but you're still going to end up with a substantial amount of home equity. But it frees up cash flow. And so this is one that we look at quite a bit. It's like, okay, you want to retire, but, you know, it's tight. Your probability of success isn't that high. This might be the thing that can work for you. You have to be comfortable with the fact that you have a mortgage. And so it gets back to, you know, that discussion we had initially was like, are you not going to sleep at night because you have a mortgage in retirement? You don't have the payment, so it's maybe not as scary as a regular mortgage, but you still have the mortgage. So then the last one here is the trade down, what is called HECM for purchase. So HECM stands for Home Equity Conversion Mortgage. That's the technical fancy name for a reverse mortgage. And so what we can do here is that you can trade down. So, you know, again, you can sell your current home and you can use the proceeds to buy another. You know, again, one of the reasons people do that is they want to have a paid for home. But then you're back in that situation where you're house rich and cash poor. Instead, what you can do is you can use some of the proceeds from the sale of the home to make a down payment and then have a reverse mortgage for the rest, which gives you liquidity because now you haven't sunk all of those sale proceeds back into another house where they're really not that accessible to you. And so you can use the sale proceeds for other purposes. Again, that could be for nursing home, whatever. So let me show you an example how this would work. So let's go back to our $750,000 house. We're going to sell it. let's assume they had a $250,000 mortgage. They had to pay some tax. So out of that 750, they netted roughly 425,000. So if they want to trade down, the max new home they could buy is 425,000 if they want to pay cash. So probably not going to work too well in Southern California. So, if you're moving somewhere else, that might be feasible. Really difficult to trade down, with home prices the way they are here in Southern California. But let's say the home you wanted to buy was $600,000. What we could do is we could put, say, a 20 to 50% down payment out of that $425,000 cash. So let's say it's a $20,000, 20% down payment. We're going to take, $85,000 of our sale proceeds, put it down, and then we'll do a reverse mortgage for the rest. And again, the calculation would depend on age and everything else. So, you may have to put more down. It would just depend. So now you'd have a $600,000 home with a $340,000 mortgage, but you don't have a house payment, and you've got $340,000 or so of cash to invest or to live off of. And so actually you would have you'd have a $400,000 or a $500,000 mortgage, but you would have $340,000 or so in the bank invested for you to live off of in retirement. So again, another option. It's one that a lot of people don't realize that you can do. They're becoming more popular now. They're being talked about in the ads and stuff. But there are lots of different ways we can use these things. They're a pretty flexible tool. So let's talk about the pros and the cons. So obviously, in terms of the cons, it's a mortgage, so you're going to pay all those normal costs you pay with a regular mortgage when you buy a home or you refinance. You've got to pay that extra 2% up front and then 0.5% per year for the non-recourse feature. You can't do one of these unless you're age 62 or older. The loan is going to grow. And so are you using up your home equity? Yes, you are. But a lot of times it's like, okay, what's the lesser of the evils? Is it I'm using up my home equity, but that's tax-free, or I'm using my portfolio when the market's down, or I'm using my IRA, which is 33% tax. So you just have to look at which asset is the best to tap into. You have to repay that loan when you die or move out. So that's why I'm saying this really is kind of a long-term play, an agent in place play. This is going to be your forever home, ideally, and so then you're going to stay there, and unless you're forced to move out or you pass away. You've got to be able to pay for the upkeep. So that's a requirement. That's like one of the eligibility features, is that you have to be able to pay for everything. And obviously, the legacy value of the home is reduced. So when you pass away, are the kids going to get less from the home? Yes, because you used it up. But you probably haven't used as much of your other assets. So it's, which pocket are we going to pull from? And so it may be a big deal if somebody really wants the home, but my experience, serving as trustee, administrator, et cetera, is the home gets sold the vast majority of the time. On the plus side, the biggie, and Blake talked about the tax treatment, it's tax-free access to that home equity. I can pull $50,000 tax-free from that reverse mortgage instead of having to pull $80,000 from my IRA. You don't have payments. So you're going to increase your cash flow. You don't have that mortgage payment anymore, or you're receiving income without payments. It's a flexible tool. We just talked about you can receive payments. You can do a line of credit. You can pay off an existing mortgage. You can have a mortgage on a trade down. You can have multiple of those, and you can make payments. And so I think a lot of times this is the way to do it. Is like, okay, we're gonna pay off our existing mortgage, and now we're gonna have a mortgage. But now my payment's gone from, say, $1,800 a month to $600 a month, because all I'm doing is paying the interest. And maybe I make extra principal payments. And maybe sometimes I make an extra payment, sometimes I don't make any payments. And really the other biggie, aside from the tax treatment, is the qualifications based on home equity, not income. So when you're in retirement, you can qualify for one of these things where you can't get a regular mortgage or a line of credit. So there are lots of pros, there are cons, there are costs. It needs to be a longer term play. You need to intend to stay in the home, et cetera. But there are definitely some benefits to them.
Yeah, and I'll add one more pro. I think one notable thing that I consider is it's an opportunity to enhance your retirement lifestyle. Especially for those that are in those go-go years when you want to travel. You have these bucket list trips that you eventually want to go on, before you kick the bucket. A reverse mortgage may be your means to accomplish those trips. Go to Europe for 2 weeks or a month and take advantage of that with this additional source of capital and not feel bad about it. I mean, as we talked about, it may be a little bit less to your kids, but you've been the one that has paid into your mortgage for decades and decades. So it could be a way to treat yourself in that sense.
Yep, yeah, good point, Blake. So we'll kind of wrap up here. We're coming to the end, and then we'll open it up for questions. So, what's our take on reverse mortgages? And I think you can probably see that we're actually fans. I mean, I've been studying these things for 25 years now, and with the new strategies that people have been looking at, with the studies that have been done, with the new consumer protections, I frankly have gone from a skeptic to a fan. But the original stereotype was well deserved. The costs were really high. The lenders were ripping clients off. They weren't holding enough back. So you were ending up in situations where the clients were underwater like right away. And so there have been legislative changes and things like that doesn't happen anymore. And then they were always used as the last resort. It was, I'm 85 years old, I'm running out of money, and so I got to tap into this because I don't have any other option. And that's the way they were marketed. There were frankly not enough consumer protections in place. And so you did have those situations where the client couldn't afford the upkeep and the house was foreclosed on. So those horror stories that you've probably heard, that's given you kind of the negative stereotype of reverse mortgages, was deserved. But that was your mom's reverse mortgage, and they weren't a good deal. But over the last 15 plus years, they've changed totally. And so, today's mortgage is not your mom's reverse mortgage. There are far more consumer protections in place. The way they calculate the holdback, et cetera. You're not going to end up, underwater. You're not going to lose the home. And they're really flexible. Like I said, there's a lot of different ways we can use it. The tax efficiency a lot of times offsets the cost of the mortgage. So, when we're analyzing particular investment vehicles, it's like, one way to look at it is the cost of tax more or less than the cost of the product. And in this case, a lot of times, because it's tax-free access to cash, that offsets those additional costs you're going to pay. And lots of studies have shown that these things are effective, and the way they should be used now, as Blake pointed out, this is like you do them early. You do it kind of first, not as a last resort. They work better that way. The costs end up being lower. You have more likelihood of probability of success, all of those kind of things. So I'm a fan. And again, we don't sell them. We don't make a single penny off of any reverse mortgage a client uses. We're typically going to look at these as one of the tools in the toolbox for you when we're looking at your retirement income plan. And I think they've gotten a bad rap over the years, and it's something that I think we should be taking a look at for most clients. We're not always going to use them, but it's definitely at least something we should always consider. Blake, I don't know if you have any other thoughts.
Yeah, again, we said it a few times, but we get no remuneration for this. We want what's in your best interest. It's part of our job. We want to give you the most fulfilling retirement because you can only do it once. And we believe that these have the opportunity to help support that. There's advantages, there's disadvantages. They're not right for everyone. But our goal for this presentation was to educate you and hopefully kind of dismay some of the negative stereotypes that come about with them and open your eyes as to the opportunities.
Yeah. So, how can we help you? The way we work is we're going to do the comprehensive retirement income analysis, and we're going to coordinate your Social Security claiming strategy with Roth conversions and tax diversification and, pension analysis and, how to tap into your home equity. So, that's our job, is to help advise you on how do you have that most fulfilling retirement. As I mentioned, we don't sell them, but we do have access. We vetted some mortgage specialists that we can refer you to. And so, it's people that we've used in the past that the clients were happy with, and that we know they're acting the best interest of our client. We're pretty protective of our clients. And then, if you're looking to trade down or any of those things, we have a network of real estate agents as well. So we can always refer you to somebody if you don't already have a mortgage broker or real estate agent. But really, our job is to advise you on having a successful retirement. So with that, I know we're a couple minutes over 7 o'clock. So let's open it up for any questions anybody might have. And we'll answer those. And again, if you don't want to ask a question now, feel free to reach out to myself or Blake, and we're happy to have a consultation with you and talk about these. But I see we might have some questions here, so let's look at them. Okay, so if you use a line of credit, is the interest rate variable based on when you take it, or is it locked? So usually it's going to be variable, like a regular HELOC. So that's one of the unknowns is what's the interest rate going to be. Yeah, they're typically variable. A regular reverse mortgage can be fixed or variable. Most of the time, the line of credit is going to be a variable rate.
So another question with that was, are there reverse mortgage worksheets that can give a general idea as to whether or not this makes sense? So you can get proposals with limited information. You don't have to disclose a lot and get a general idea as to what a reverse mortgage would potentially look like for you based on what Jim talked about, the equity that you have in your home and your age and the location of where you live.
Yeah, and then the last question here is, are there specific features we should look for when researching these? Honestly, what we do is the reverse mortgage people that we refer our clients to are brokers. So they, just like a regular mortgage broker where they can shop it to a bunch of different people, a reverse mortgage broker can do the same thing. And that's usually the best way to go. So we see that they can go to 5 or 6 different companies and get different proposals with different interest rates. You probably don't want to go to the ones on TV, the Tom Selleck AAG, where they've got one proprietary product. You, just like any other product, whether it's life insurance or whatever, you typically want to shop it with a broker who can have access to a bunch of different companies. And then one more question here. How does it work if I have my house in a living trust? The living trust is essentially your alter ego, so it shouldn't impact anything.
Yeah, you would just submit the document when you were getting your reverse mortgage and make sure that the broker knew that the home was titled in the name of the trust.